Is it still a good idea to buy investment property? Hi, my name is Patrick Rankin from Good Neighbours Property Management, property manager and business owner. I'm sitting with a good mate, Matt, from One Stop Financial Solutions. He's one of my go-to financial advisors as well as a mortgage broker. I'll let Matt introduce himself.
Yeah, thanks for that, Pat. Yep, I appreciate it. So, a bit of a question we've been asked a lot lately under the new tax deductibility sort of laws or changes that are looking at coming into effect. And my question usually boils down to, well, I usually answer this question with another question is, I guess, what's our alternative? If it's not property, can you show us or show me as a financial advisor, close to guaranteed, if we can say that word, viable alternative where we're earning similar or better yields, with low to moderate risk. So as we know, the share market can be an option if we're extremely well versed in that area, and digital currencies at the moment are getting a lot of hype and attention, but we all know and can agree they're quite volatile, and again we need to do a lot of research and things like that. So the fundamentals around property absolutely are still there. It's an income producing asset. End of the day, tenants, they need somewhere to live. So
absolutely.
I still say over time, buy good quality assets, income producing assets and property, and over time they tend to appreciate. We have to remember, even during the GFC, prices decreased at a high decrease of between regions no more than 7 to 9%. So to put that into context, it wasn't even all that scary, even during the midst of the GFC.
Yeah, that's true. It did a lot better than stocks, didn't it?
Oh yeah, absolutely.
No, thanks for that. So in terms of finance, where do you see the short-term and long-term interest rates?
Yeah, the short-term rates have actually come down a little bit, ever so slightly, mainly around 10 basis points, so hovering at around that 2.25% with the mainstream banks. There's a few outliers in that, HSBC, for example, or Heartland, they might be doing a little bit lower. Keep in mind that that's usually for the 1 year rate only, and usually there's no sort of cashback incentives that apply as well. So if we factor in everything between, say, receiving 2.25%, but a good strong 0.7 or 0.8% cashback if we were looking at restructuring or our portfolio, our lending, often when we take into account all the maths, it's pretty similar really. But my big question is, what happens in year 2 or year 3 with those real lower lenders at the moment? Are they still going to be guaranteeing that sort of interest rate in the 1s or even in the 2s? So
in year 2 and year 3, is that still short-term or medium-term thinking?
It's probably starting to get 2 years is, short to medium term, and 3 years is, that's much more medium term thinking. So the interest rates have actually increased slightly there.
For the 3 year?
3, 4 and 5 year fixed terms, which if we read into that would typically suggest that interest rates might start to be increasing a little bit, or rather I'll rephrase that, the banks themselves might be predicting or almost gambling that the interest rates will be increasing a bit to try and secure or lock people in for just the 1 year because it's looking more attractive, so that if interest rates come off, their fixed term renews in 12 months' time, those rates have increased and they'll take advantage of that, and then interest rates have increased.
So as a strategy, how do we use the short-term and long-term interest rates in order to play the game of investment property or monopoly?
Probably 2 main strategies right there is interest rate averaging, so taking your portfolio and saying, look, let's not put all of our eggs in one basket. This is a very traditional, very safe and secure way to go about things. So let's spread things over the 1, the 2 and the 3 year rates. And that's acknowledging that no one's really got that crystal ball. No one really knows are rates increasing or decreasing, or are they staying the same. So some of your portfolio, say a third of it, you would have done exactly right. A third of it, you might have got it a bit wrong, and another third, you might have got it a bit more wrong.
Fair enough.
Hey,
that's good.
We might not be winning big time by getting that absolute lowest rate, but we're not probably losing big time. But myself personally, I still just go for the 1 year rate.
Yeah,
because
me
it's,
too.
it's always the lowest.
Yeah.
Yep, nearly always the lowest. And if I get it wrong and interest rates start to increase, and that's the key word, increase, you can break a fixed term mortgage, and typically there's no break fees if interest rates have increased. Break fees apply when there's a loss or a cost, a real cost to that bank, and that typically happens when we exit out of a fixed term mortgage when the interest rates stayed the same or decreased. But when banks are increasing, they're winning because you're exiting that contract and they can use that money to refix to you or another client at a higher interest rate.
Oh, good. All right, thanks for sharing that. Couple more questions around budgeting. I work with a lot of landlords and tenants. What would you say is a good percentage of your income to be used towards rent or that mortgage payment?
We would always aim for approximately, and all things being equal, around that 40 to 45, 50% range. But in saying that though, it's not untypical for first home buyers of ours to be up at around that 60-65% range, which might seem high, but there's usually a few mitigating circumstances with that. An example would be maybe they've got some dependents whereby the little ones are now turning 3. They were 2, now they're 3, which means the ECE, the 20 hours free,
the childcare costs
coming down, you've got it. Or likewise, maybe the little one is turning 5, so going to public schooling. A lot cheaper than daycare, I know that for a fact.
My little one started secondary.
Yes, same here.
I mean primary, started
primary school, same here. It's nice, eh?
Yeah.
It's about $300 in the hand for me, so
Oh, that's good.
And student loans is another big one for first home buyers. If it's projected that the student loan's only got a couple of grand owing, and at 12% of our income goes toward our student loan. All income above $20,000 annually, 12% of our income has to, by default, go towards that student loan.
I see.
So once that student loan's gone, it's effectively a 12% pay rise.
That's true.
So, and this is how we, giving away all my tips and tricks here, but that's how we get our applications across the line when first home buyers are looking tight. We really dig deep. So what might look quite tight, 60%, you might go, well, that's unaffordable. What are we doing? That's sort of irresponsible lending. Well, no, not necessarily if we break it down and dig really deep.
I see. Now that sounds good. So on that budget, we're still on the budget topic. If I was buying my first rental property or my 5th rental property, what would the banks look at in terms of the rental income? How much of the rental income will be put towards servicing that mortgage?
Very good question and very timely. So traditionally it's always been 80 to 75% of the rental income. As of last week, ANZ, they're the first bank off the back so far of the recent announcements around the tax deductibility changes to say, pretty much line in the sand, all existing properties or portfolio, the rentals on those, they will only use 65% of the income, rental income received from those. So effectively it's a 35% haircut on existing stock.
Ooh, okay, I see.
So if we can read into that, what do we think might happen towards new homes? New homes. So developments, fixed price builds or turnkeys, I'm suggesting they're going to be looking quite popular.
They would be.
For investors and even first home buyers still alike.
I see.
Yep.
Okay, no, that's it from us. Thanks guys for the time, and if you guys need a financial advisor or looking at getting a pre-approval, call Matt at One Stop Financial Solutions. Myself, I'm obsessed about what I do, and I love working with people who are obsessed and don't only go the extra mile but the extra 10 miles.
Absolutely.
Yeah, so you guys take care. I will leave Matt's details in the comments of this video.
Thanks team, talk soon.
Bye.